Hi, and welcome back again to Options and Volatility, Hedges and Edges. We'll take a look at a follow-up, a closeout trade from our UOA today about a month and a half ago on ASTS, where a big-time repeat call buyer initially set up a vol capture trade with big-time edge. Then once that call buyer kind of stepped away, we see how the IV reverted back as expected, and you can close out for a very nice gain with the stock literally going nowhere. So we can term this our money for nothing trade. So let's jump in and take a look. Here is the original trade idea. Again, going back about a month and a half ago. Anyone who wants to look at it can certainly go to our YouTube channel. Take a look at that, no problem at all. It's under US UOA today, file capture trade idea. So that's going back in time. The thesis was big volume. We saw big repeat call buying in ASTS on the options, which certainly spiked implied volatility. Here's a look at just how much this was included in the original video from a little over a month ago. You can see implied volatility absolutely off the charts here. We elected to go long term out about a year in time, right? Simply to kind of have a huge cushion on the trade, right? Bringing in big premium and able to capture some nice IV back there. Longer term vol, even though percentage wise it doesn't move up as much, price wise it certainly does. So this set up for ideally several vol capture trades selling a straddle and a couple strangles. Then you can see once that call buying dried up, here's that implied volatility spike, and literally to the day, right, that we came up with the original trade idea, trading at over 150 on the 360. You can see once the buyer stepped away, that IV collapse reverted back to basically where it had been most of the time. This set up the closeout trade, which happened Friday. You can see on a longer term basis, this is for the entire history. ASTS stock has only been around for a couple of years now. You can see implied volatility got to the highest ever. That's set up ideally for our vol capture trade, selling a straddle, selling a couple strangles, right? Looking for IV to revert, doing it in a somewhat price neutral fashion, not delta neutral as much, simply because that lift in IV made the out of the money calls have a much higher delta than really they should be, right? But we certainly have no problem at all taking a position, a guarded position, by selling both the calls and the puts. And then you can see that long-term vol has reverted back. Here is the day we came out with the initial trade idea, right? Then here is Friday, where we said look to close out the trade. And you can see again the IV back in September 6th got to 100%, the highest it had been over the past year. Then on Friday dropped down to 56%. So basically got back to average, and that's all we're looking to do, right? Sell inflated implied volatility, right, caused by big option volume. Once that volume dries up, implied volatility tends to revert back. We do it in a somewhat neutral fashion, right? Not taking a directional bias on the trade. Once IV reverts back, we look to take the trade off for a profit. So taking a walk through, here was, the day before, a little while before that big call buying. You can see that Jan 30 straddle trading about 26 bucks, just under. Then here's the day of that huge call buying, right? That came in mostly on the shorter term options. You can look at the previous video. We went through that in detail. But you can see with the stock actually moving up, right, from 22 and change to 26, that straddle got much more expensive by almost 5 points. Why? Because implied volatility now over 130. Before it was trading somewhere in the mid 115-ish range or so. Then we can see what happens to that straddle again going out in time. Here's the day of that big call buyer. And then on Friday, the buying had dried up. We see IV revert back to that straddle. 25 bucks now, right? Not too long ago on September 6th, right? It was trading over 30 bucks, so able to pick up over 5 bucks. The stock 26.11, and it had only moved down slightly, right, by about 50 cents or so. So not a big move price-wise, right? And then if anything, the straddle moving away from 30 should make the straddle price more expensive, but it dropped hugely. Why? IV now is reverted. Same sort of thing here on the 30-15 strangle, right? 1380 before that big call buying started. Stock was at 22.32. Day of the big call buying really culminating, right, where we saw that huge IV spike, right? That is where we saw the IV now shoot up to over 130, and that strangle, right, with the stock now at almost the ideal spot between 15 and 35, right, actually added on over 5 points, right, simply because of this huge spike in implied volatility. Interesting to note too, right, that the 15.55 call spread, right, was actually higher than the 15.35 was back before the big call buying came out, before that big spike in implied volatility. So that 15.55 certainly was another way to capture it, right? You can see that 15.35 then reverted back once the call buying dried up to under 15 bucks. We can also take a look at the 2035, a little more, less bearish, if you will, a little more bullish trade, right? But with the 22.32 price of the stock, certainly the put's much closer to being in the money than the call. That strangle priced at 16.75. Then the following day, with that huge spike in implied volatility, we saw it jump all the way to 22.40, as you can see here. Implied volatility again shooting up off the charts here. So another way to go out and capture that trade. So that is certainly what we look to continue to do. You can see now the 20.55 drop back to under 15 bucks once that big call buying stopped, right? And you can see what that 20.35 closed under 18 bucks once that big call buying stops. So here's a quick little summary, just kind of going through again how we look to capture this implied volatility. We kind of went through these two, right, in the initial video. You can certainly look on that on the channel, a more in-depth look, right? We're going to take a look more at this, right, which is the day of that big IV spike, right, going in and selling the straddles, selling the strangles, right? So that 30 straddle, getting 30.45 for it, IV around 133. The 15.35 straddle, 19.5 bucks. IV about 131. That 20.35, 22.40. IV again at 132.50. Then on Friday, and it's about 49 days after the fact, so days have passed, right? And obviously selling, option premium, you do have positive time decay, but very little, only about a penny a day or so on the calls or puts. So expect to make about 2 cents a day on the trade by selling it with 49 days. You'd expect to make just under $1 profit just from time decay, right? We have out in time to 2026, so a lot of time decay. It's not going to happen quickly. We're nowhere near expiration, but time decay is certainly an advantageous factor. Anytime you're looking to do these vol capture trades, you get that positive kind of theta impact as well. So you expect to make about $1 or so on time decay. And then since the deltas, and especially because of that lift in implied volatility, kind of were skewed a little bearish, the stock did drop 49 cents. So the stock dropping $0.50, you'd expect to make a little on being short deltas as well, right? So walking through the trades here, you can see the delta on the straddle would have been minus 40 deltas, right? Because we're selling basically a 70 delta call and a 30 minus 30 delta put. So it'd be short 40 deltas by selling both. So expected delta gain about 20 cents. The theta gain, as we said over here, is going to be the same for all the trades here, just a little bit under $1. So you expect to make just under $1.20 on the trade by having the stock drop a little bit and time decay pass. Yet, because that huge IV drop, we actually made about $5.50. That IV going from 133 when we were looking to put that trade on by selling it. Then when we said Time to take it off. IV has reverted, right? Dropping to basically 111, so a 22 and change IV drop, right? We're able to capture over $4 simply because of that IV drop, identifying that big pop and drop in implied volatility on the trade. Going through the 1535 strangle, same thing as well. Delta, about 60 deltas net short, right? Even though the 35 calls were about the same amount out of the money as the 15 puts because of the high IV and because of basically upward drift in stock prices. Out of the money calls carry a higher delta than similar out of the money puts. So our expected delta gain by having the stock drop again about 50 cents, being short about 60 deltas, about 30 cents, right? Theta gain making about $1, so you expect to make about $1.30. We actually made $4.65 on the trade. Why? Because of this huge drop again in IV from 131 to 114. So that 17-point IV drop simply because that huge spike in buying caused that huge rip higher in IV. Once the buying of the options, especially on the call side, dried up, we saw IV revert back. So our vol capture on the trade, what we were able to make simply by identifying that vol pop, well over $3. And then finally 2530 or 2035 strangle, same idea there. We saw IV drop again, 17 points, right? You would have been about 46 deltas net short on the trade. So your expected delta gain, right, would have simply been the 46 cents, right, times our change of the stock price, right? So you'd expect to make about 22 cents, right, from a delta standpoint on the trade, and then about $1 on the theta, the time decay, right? So you expect to make about $1.21 on the trade. We actually made $4.55, so our vol capture $3.34. So this is the way we go about identifying how to take advantage of these huge pops in implied volatility, right? You can see again, just looking to identify when big volume drives IV to extremes, right? And then cover the trade when IV invariably reverts. And obviously this is about the most extreme the implied volatility on ASTS stock has been ever, and then that reversion, right, putting it on in a guarded fashion. And again, looking at the trade, right, if we take a look just at that 30 straddle from when we put the trade on, right, we would have gotten over $30 net credit. So the downside on the stock, if ASTS goes to zero, we still make a little bit of money on the trade. Break even to the upside, if you project it out simplistically, right, would be roughly around $60. So you'd need more than 100% move on the stock for the trade to get in trouble. So we're certainly willing to take that chance as well, although while waiting for IV, which has been at historic highs, right, we're more than happy to take a guarded stance, sell this incredible spike in implied volatility once it reverts back. In this case, took a little bit less than 50 days, look to take the trade off and move on. So hopefully explains how we identified trade possibilities, how we look to structure it in a protected, somewhat guarded fashion, right, giving a huge edge to the trade. So until next time, as always, here's the good trading. Take care.